We now turn to valuing options. Options valuation methodologies tend to fall within the cash flow adjusted approaches to valuation. It's going to be based primarily on the act of arbitrage. And so it's important to, if you want to understand option valuation, it's important to understand the role of the arbitrageur. If you're thinking, well, I'm working in the bond space or the stock space, I really don't need to understand options. I think you'll find several tools that are useful in appraising stock values and bond values with a deep understanding of options. And so one way to view a common stock is as a call option on the firm. That opens a whole host of different ways to do valuations for stocks as well as bonds. And so we're going to explore numerous boundary conditions. American style refers to being able to exercise at any point up and through expiration. European style is only at expiration. Just out of completeness, we'll examine upper and lower bounds, but lower bounds tend to be the binding constraint, and that's where we'll put most of our focus. We'll address both call options, which give you the right to buy, and put options, which give you the right to sell. And we're going to introduce the notion of a cash flow table. For arbitrageurs, it is easier to understand what they're doing if you view everything in terms of cash flow. If I make a $100,000 investment, then my cash flow is minus $100,000. And we'll be looking at some actual evidence from the options market. So the central financial concepts are simply the role of the arbitrageur. The goal is to estimate or to document what the boundaries are as well as parities. And we'll look at the role of intermediate cash flows such as dividends and look at some evidence. The arbitrageur, the act of arbitrage, is typically a series of transactions that result in a positive cash flow today with no future liability. The word arbitrage, at least from where I sit, has been corrupted and used in a whole host of different, to refer to a whole host of different activities. I take a very strict definition. If it doesn't involve putting money in my pocket today without taking any market risk in the future, it's not arbitrage. And so there'll be two types of arbitrage. Within the boundaries and parities, we'll be doing what's known as static arbitrage. Static arbitrage refers to only doing a transaction today and then some subsequent unwind. It doesn't require any intermediate trading. When we get to the binomial models as well as the continuous time models, we'll have to rely on the capacity to do dynamic rebalancing, and that'll be dynamic arbitrage. In order to understand the life of an arbitrageur, they operate based on two guiding principles. One is don't spend your own money, and the other is don't take any market risk. The arbitrageur, clearly, if you think about this, this is a great way to make a living if you can find enough arbitrage transactions. Because you're basically putting money in your pocket at no risk in the future. Arbitrageurs tend to be liquidity providers, which is an incredibly important function within well-functioning financial markets, and they end up being also market makers. So they set the bid and offer prices for options. Often those bid and offer prices are a direct result of the economic cost of conducting arbitrage transactions. We'll be looking at a variety of boundary conditions, but let's start with the simple condition of the option price should be non-negative. That is, it should be zero or positive. The economic argument is simply liability is limited. If I buy a call option, I never have the obligation to actually exercise it, and I can exercise it only if I wish to. Thus, it should not carry a negative value. The arbitrage argument is distinctly different from the economic argument. Basically, the arbitrage argument goes as follows. A series of transactions are executed that result in money inflows to the arbitrageur with no chance of future money outflows. Simply put, cash in the pocket today, no chance of cash coming out of that pocket in the future. That's an arbitrage transaction. Hence, if I observe a negative option price, I will buy it and then I might exercise it later if it ends up in the money, but I could always throw it in the trash can. Lower boundaries are often violated. Upper boundaries are rarely violated. When we get to the technical aspects, we'll document these upper boundaries, but it's just mainly for completeness. Parity conditions, if we have a European style option, we can establish a exact relationship between four markets: the call market, the put market, the underlying instrument, which we'll assume is a stock throughout this discussion, as well as what I call financing. I might need to borrow or lend, and so generally there's a financing facility of some sort set up with the arbitrageur. I was once in the CME building and working with an arbitrage trading firm, and when you got off the elevator, to the right was the arbitrage trading firm. To the left was an investment bank that provided capital if they needed to borrow money or if they needed to park additional money for a short period of time. And so the bank provided borrowing and lending at a prearranged rate. And so the arbitrageurs knew that they had access to financing. Again, there are four markets: the call, the put, the stock, and financing. European style, the parities end up with an exact equality. Obviously, with transaction costs and other market frictions, there'll be small boundaries in which that operates. With American style options, that is, I can exercise it at any point between now and expiration. The American style parities result in ranges or inequalities, and these inequalities tend to be much more narrow than lower and upper boundaries. Because we're going to be looking at actual data, it's easier to normalize prices. And so because there's a diversity of exercise prices, option maturities, and differing underlying instruments, it is often preferred to express boundaries and parities as a percentage of the underlying instrument. For example, if the stock price is 100, if the market price of the call is $14.23, then the normalized call would be 14.23% of the underlying stock price. Cash flows, intermediate cash flows influence these boundary conditions. And so because we're focused on stocks here, there are dividends in the United States. The individual stock dividend payments tend to be quarterly. And so we'll model those discretely with indexes like the S&P 500. If 100 of those stocks pay quarterly dividends, then there are 400 dividend payments during the typical year. And so modeling that with a continuous cash flow is also possible. And so equity indexes often have hundreds of quarterly dividend paying stocks, hence the continuous cash flow methodology is deployed. We now turn to looking at some actual data. We're going to look at before the financial crisis, during the financial crisis, and after the financial crisis. Before is what I call a normal market. It's in air quotes because technically I don't believe I've ever observed a normal day in the markets. However, the great financial crisis was unusual and atypical, and so we'll look at option prices during this time of deep uncertainty on December 15th, 2008, and then we'll look at December 15th, 2011, after the financial crisis. And so if we focus first on the American style call, lower bound the intrinsic value in the call price for SPY, which is a options on an ETF, an exchange traded fund that tracks the S&P 500. It is an American style option. And so a couple of observations to make. First of all, the mid price is the average of the bid and ask price, and the x-axis is strike price divided by the stock price. So on this particular December 15th, 2005, we have a variety of different strike prices. If we normalize it by the stock price, it'll give us an easy ability to compare different dates. And then notice that the call price is normalized by the stock price also. So for the lower the strike price, the higher the call option because it is further in the money. So this looks backwards if you're familiar with these hockey stick diagrams. It looks like I've got it backwards. But because I'm normalizing by the stock price, as I lower the strike price, the stock is further in the money. Another observation to make is as I go further out of the money, the option price tends to zero. When I go further in the money, it tends to the higher of the intrinsic value or the European style call lower bound. Because these are American style, it could be exercised early because this is dividend paying. When we get into technical details, we'll look at this more. Notice that the interest rate during, quote, normal markets, the interest rate is higher than the dividend yield, and hence the call lower bound is actually higher than the intrinsic value. And we would say that the call lower bound is the binding lower bound. If we look during the financial crisis, the first thing to notice is that the call prices are significantly higher. The second thing to notice is the index was trading at 87.75 in 08, but in 2005 it was trading at 127. So the underlying ETF SPY lost a tremendous amount of value. When the price goes down, the dividend yield actually goes up. And so what we observe now is that the dividend yield is in excess of the interest rate. And that causes the boundaries to flip. And so the intrinsic value is actually higher than the European style lower bound. Although it's difficult to see here, the option prices are trending towards zero as I go further out of the money, and they're trending towards the highest lower bound when I go further in the money. The key insight is during times of great market uncertainty, option prices are very high. In the post-crisis period, that is December 15th, 2011, what we observe is that the option prices have dissipated. They've calmed down quite a bit. And if you'll notice, interest rates remain very low. This is 62 basis points down here. And the dividend yield was 3.14. The underlying index had gone back up. But again, the European style call lower bound is above the intrinsic value. And what we observe is the actual mid price is asymptotically moving to the highest lower bound. If we turn now to focusing on the option time value, the couple of insights to notice. One is that the time value is not symmetric, and so if I go further in the money, this doesn't look the same. There's more time value than out of the money. And when during the financial crisis, that the magnitude of the time value is much higher. The asymmetry between the two sides is not as severe. And then when we go back to normal markets, again, we find that these deep in the money options have higher time value relative to the out of the money options. And so there's a lot to be learned by exploring these the lower bounds and how options actually behave with regard to these lower bounds. But it does appear that there exists this class of traders known as arbitrageurs, forcing the call price to be above the highest lower bound. We'll pick up with put options in the next video.